Welcome. Today we're going to take a look at what conceptual framework. Yes, this conceptual framework is what the foundation upon which those standards have been uploaded are coming from. Yes, this is supposed to come first, but it's still never too late. Yes, now conceptual framework are what foundation for the development of what accounting standard and how this financial statement should be prepared and followed. Now, it is upon this conceptual framework that standards are built. That you have IS 1, IS 2, IS 3, FRS this, FRS that. They are all what built upon what this conceptual framework. And in this, we are going to go deep into it to know what and what are contained in this conceptual framework. Because it is from here that you got all other standards. Now, take a look. Now, the conceptual framework for financial reporting is issued by the International Accounting Standard Board (IASB), serve as the foundation for the development of accounting standard and guide the preparation and presentation of financial statements, as earlier said. It provides a coherent set of principles and concepts that underline financial reporting, ensuring what consistency, transparency across all financial statements. You get ensuring what consistency. Like when you take a look at financial statements, you find out that you get your what your income statement first. Sorry, if you take your detailed account, now normally when preparing your income statement, your financial statement, you get your income statement, you get your balance sheet, that is financial position, cash flow, then change in equity and notes to the account. The consistency in the arrangement is what this conceptual framework is also interested in. The transparency involved is what it's also interested in. And how to arrange the financial statement. It's all embedded in the conceptual framework. Now, what is this objective of financial reporting? Objective of financial reporting. The primary objective is to provide financial information that is useful to existing and potential investors, lenders, and other creditors in making decisions about providing resources to the entity. This includes information about the entity, financial position, and financial performance, and cash flow. Now, objective of financial reporting. Now you hit the users, you target the user. Who are the users of this financial information? You get the investor, the lenders, the creditor, the debtors, the stakeholders, and the government. You get. So the objective of the financial report is to give them what? Provide financial information that is useful to enable them what? Make decision out of the financial statement. Once they handle any financial statement, they should be able to go into the income statement, to go into the financial position, to go into the cash flow, change in equity, and make useful decision whether to invest in the business or not, whether to lend money to the business or not. You get whether to transact one or two business to them or not, to make what useful what decision. That is the objective of this financial reporting. Now, we have qualitative characteristic of financial information. Qualitative characteristic of financial information. We have under this we have fundamental qualitative characteristic. Here is highly examinable. We have what fundamental qualitative characteristic and we have enhancing qualitative characteristic. Now, if there's now let's take a look at the fundamental qualitative characteristic of financial information. Relevance is one. Financial information is relevant if it can influence users' economic decisions by helping them evaluate past, present, or future events, or confirming or correcting their past evaluation, such as materiality, predictive values, and confirmatory value. Now, the financial statement you are giving to them is irrelevant. Can they evaluate the past performance of the company, the present? Can they look into the futuristic aspect of it? That is the relevance. Now, if you if you take a look at audited financial statements, you find out that they always have the previous compare with the current. Relevance, materiality, correcting, getting relevant things in that financial statement. Is it relevant for them to make decision out of it? Is it worthwhile for them to hold on to? Relevant. The second one is faithful representation. Faithful representation is what? Financial information should faithfully represent the economic phenomena it purports to represent. It should be complete, neutral, unbiased, and free from errors. Faithful representation. The financial statement that you are giving to the users, are they faithfully represented? Are they neutral, unbiased, no error inside? Yes, if all these things are not there, then it is faithfully represented. Some of the financial statements are doctored. They do what we call creative accounting. First balancing figures. Those ones are not faithfully represented. Any account that is forcefully balanced is not faithfully represented. It's not free from error. So your account must be what? Faithfully represented. Now, those are the two fundamental qualities, relevant and faithfully represented. Now, let's take a look at enhancing qualitative characteristics. These are the fundamental. Now, let's go to things that enhance it. Comparability. Users should be able to compare financial statements across different periods and entities to identify what differences and trends. Comparable. Is it comparable? Can we compare it with other financial statements? Can we compare it with Mr. A? Can we compare it with this? Is it the same? The arrangement and everything, are they the same? Are they comparability? Yes. The financial statement should be what? Comparability. When somebody in Nigeria and somebody in US are holding the same different financial statement, the arrangement, the setting of this conceptual framework should be the same in both accounts. Comparability. Now, verifiability. Different knowledgeable and independent observers should be able to reach a consensus that the information is faithfully what represented. Verifiable. It can be what? Verified. Can you verify anything? It should be what? Verifiable. Then the next one is timeliness. Information should be available to users in time, on time, to be capable of influencing their decision. It should be very what? On time. They should get the financial statement on time so that they can make decision out of it. Timeliness. Those are enhancing qualitative characteristic. Is your financial statement understandable? Financial statements should be presented clearly and concisely, making it understandable to users who have a reasonable knowledge of business and economic development. Financial statements should not be something somebody will hold and be confused. Those that have understanding of financial statements should be able to understand what the financial statement is all about. Why? Because you followed the normal procedure in preparing it. When you deviate from the normal conceptual framework, from the normal way in which you prepare the financial statement, then that financial statement can no longer be understandable. But once you maintain the track and prepare it, whoever handled it, as long as the person is knowledgeable in business, the person will be able to understand what we are saying. Now, let's take a look at the elements of financial statement. This place also is highly examined. Now, there are what we call elements of financial statement, and there is also components of financial statement. These two things go a long way confusing people. Today, we're going to take a look at elements of financial statement. What components are example income statement, balance sheet, financial position, cash flow, change in equity. Those are components. But here is the what element. Assets, resources controlled by the entity as a result of past events and from which future economic benefits are expected to what flow to the entity. That is assets is one of the elements. Secondly, liability, present obligation of an entity arising from past events because you've borrowed past events. The settlement of which is expected to result in an outflow of resources embodying economic benefits. Liability is also what element. Equity, the residual interest in the assets of the entity after deducting liability. This also is what elements. Income and expenses are also part of these elements. In yeah, income, increase in economic benefit during the accounting period in the form of what inflow or enhancing of assets or decrease in liability that result in increase in equity. So these are what elements of financial statement: asset, liability, equity, income, and expenses. Now, let's go to recognition and the recognition. Now, how do you recognize elements in the financial statement? An element is recognized in the financial statement when it is probable that future economic benefit will flow to or from the entity, and the element has a cost or value that can be what reliably measured. Whatever element that can be reliably measured that have economic benefit to the organization should be what recognized. That is what recognition. Now, the recognition, the removal of asset or liability from the balance sheet or financial statement when it no longer meets the criteria of recognition. Now, there are things that meet the criteria of recognition. When an element meets the criteria of recognition, you will recognize it in your financial statement. But in a situation when that element no longer meets the recognition, the criteria of recognition, you do what? You pull it out from the financial statement. That is all about recognition and the recognition. Know when to recognize and when not to recognize. Know when to pull out. Why? Because it's no longer what viable or it doesn't meet the criteria for recognition. That is that. Now, basis of measurement basis of this element of financial statement. Now, the framework identifies different measures basis which include revaluation model. You revalue your asset, cost model, value in use model, and realization value. These are the measurement basis we use. The choice of measurement Measurement base depends on the nature of the element being measured and the information needs of users. Presentation and disclosure. Financial statement should be presented in a way that enable users to understand the financial position, financial performance, and change in financial position of the entity. Now, this conceptual framework is just enlightening us on what we should know whenever we're preparing what our financial statement. That is why I said it is the bedrock upon which accounting standards are built. It is from this conceptual framework that we have all those standards. Disclosure should provide additional context to help users understand the information presented. Capital and capital maintenance. Now, capital and capital maintenance, these are two things. Now, let's take a look at capital. Capital could be physical or financial. Yes, capital could be physical or financial. The capital could also what be in volume or capacity, or capital could be what in net amount. You get that? Capital could be in volume, it could be in net amount, it could be physical, it could be what financial. So those are capitals. Now, capital maintenance. How do we maintain capital? Now, capital maintenance, that is the money you borrowed to start your business, or the amount that was contributed by shareholders made up your capital. And how do you maintain this capital? How do you maintain the amount you borrowed into the business? How do you maintain the amount that the shareholders have contributed? Now, debt, you maintain it by what? Interest. You pay interest to those who you borrowed money from. Capital maintenance. You maintain it by giving them their interest. Shareholders, how do you maintain your shareholder? By giving them their dividends. Once you pay them their dividends, you use your capital and do your business. You come again, you pay them their dividend, you use the capital and do your business. Capital maintenance. That is self-explained, right? The framework also address concept of capital and capital maintenance, explaining how to distinguish between profit and return of capital, and ensuring that financial statements reflect the entity's ability to maintain its capital over time by what? Paying shareholders their dividends and paying interest to amount borrowed, maybe from the bank. Right? Good. I said the capital is divided into physical, volume or capacity, and financial net net amount. Sorry, net amount, not profit. Now, importance of conceptual framework. Importance of the conceptual framework. Let's take a look at the importance of the conceptual framework. Standard setting. It provides a guide for the development of new accounting standard and the revisiting of existing one. Now, this conceptual framework what did was help in setting standard. The IS1 you are hearing, the FRS 18, the new one you are hearing, the IS2, all the standard that you are hearing. This is the importance of conceptual framework. They set standard and revisit the old one to do one or two amendments from it. So one of the important is that it provides a guide for the development of new standard and revisiting of the existing one. Consistency. It ensures consistency in the application of accounting principles and standards across different entity and what period. It help it help for us to maintain consistency in the financial statement because this conceptual framework is built is the is the foundation to which all other standards are built. You understand? So it helps us to what to remain consistency by giving us a standard, a setting to follow. Guidance. It helps the preparer of financial statements makes decision when no specific standard apply to a transaction or event. When there is no specific standard, the conceptual framework help the preparer of financial statement to make what decision. Users understanding assist users of financial statement in understanding the information provided, how it is generated, and its relevance to their own decision making. Now, conceptual framework is not a standard itself. It is not a standard, but it serves as the foundation for developing consistent and transparent financial reporting standards. So, with all this, you have financial reporting at your fingertips because this conceptual framework is a breakdown, is a foundation upon which all those standards are built. So for you to be good, you have to know all these standards one by one so that when preparing financial statement, you can be applying them one by one. I hope this video helped. Thank you very much. See you in our next video.